Let's attain financial freedom. What's the difference between you and the top 2% of the people that are living their financial dream? Is it the habits they adopt, or the wealth they have accumulated over time, or the wealth they have inherited, or is it the business they own? What if I can tell you that your financial freedom is rooted in the habits that you also need to adopt? On this podcast, I am going to help you understand and know the basics habits that you need to adopt in order for you to achieve your financial dream. Welcome to our new Money Habits Podcast, Episode 9. How do home loans work exactly? A home loan makes home ownership a realistic option for those who might otherwise have perceived it as a distant dream. Home loans are designed that consumers may be able to take a mortgage so that they can be able to purchase the home of their dream and pay back the lender in monthly installments. What is a home loan? A home loan is when a lender, usually a bank, lends you money you need to cover a home purchase. It's good to know that if you find your dream home, you have a way of obtaining ownership of it without having to pay the full price of the home upfront. A home loan means you pay the price of the home back in monthly installment, usually over the course of 20 to 30 years. Applying for a home loan. You apply for a home loan after you and the home seller have signed the offer to purchase, a deal which dictates the terms that you and the seller have to fulfill. So what criteria does the bank use when deciding whether to grant you home loan application? The lending criteria varies from one bank to another, but one critical aspect that they all investigate your credit record. How does a home loan work in terms of repayments? Every month you pay back a portion of the home loan along with interest. The amount of interest you pay depends on the prime interest rate, the rate of the home loan, and other factors such as whether you opted for 20 or 30 years bond. Be advised though that a 30-year bond means you'll pay more in interest on the loan. Basically, your home loan interest rate is determined by how much of a risk the bank consider you to be. There are ways to mitigate this, such as paying a larger deposit or improving your credit records. This will result in lower interest rates and saving you money in the long term. What is your credit record? Your credit record is a 3-digit number ranging from 000 to 999. The higher it is, the better your chances of a home loan approval and the better the interest rate you are offered. Factors such as your debt, repayment history, amount owed, and type of credit applied for are taken into account when calculating your credit score. Your credit score reflects your financial health. The deposit. Home purchases often require you to pay 10% of the home value upfront. This is referred to as the deposit. Banks are trying to attract more first-time buyers by offering a 100% home loan. A home loan that doesn't require a deposit, since young home buyers are less likely to have required funds for deposit. However, if you do have the funds for deposit, it is recommended to pay even more than 10% if you can. The higher your deposit, the better your chances of home loan approval and the lower your interest rates will be. Higher deposits takes away some risk of the bank, making them more likely to grant you a favorable package. Welcome to our second part of our content. Here I will be sharing 4 mistakes home buyers should avoid, especially first-time home buyers. Number 1. Not starting the approval process early. Before you can start the process, you need to get your mortgage approved first. Start with the process of getting the approval. This can also help you know your budget before going around choosing. Number 2, looking at one mortgage code. Getting more than one mortgage code can be time consuming with the documentation and movement from one place to another. However, it can also help you choose from all the codes the most suitable one. Number 3, not working with a real estate agent. Buying a home by yourself can be more riskier yet more cheap, but you need an expert in the field, a person who will help you choose the best house on the block. Number 4, buying more than you can afford. Be sure you consider all your monthly expenses before taking the mortgage. Most lenders use DTI ratio to calculate your affordability, but this doesn't include your expenses. Thank you for tuning in our new Money Habits podcast. Don't forget to like and subscribe. You can also click on the link below on the description button to our Facebook account, where we share most of our content on a daily basis.